Subcommittee on Government Operations and the Subcommittee on Intergovernmental Affairs will come to order, and without objection, the Chair is authorized to declare a recess at any time. Good morning and welcome to everybody to this joint subcommittee hearing on improper payments at the Department of Education. Today's hearing is a continuation of the committee's work to oversee improper payments throughout the government, and also is a continuation of the committee's oversight of the federal student aid program. Improper payments is an important topic that doesn't get enough attention, and is also critical for us to get it right. Addressing this area has been especially challenging at the federal student aid, which, given the richness and complexity of the programming. Student aid disbursements, which total nearly $130 billion a year, are made in accordance with complex rules, some of which are too burdensome, and in conjunction with stakeholders at schools, contractors, and college access providers. Rightfully so, the Inspector General, who we welcome today, has designated this area as a management challenge, quote, for the agency. This has been a management challenge for FSA since 2012. Let's be clear, though. FSA has all the tools it needs to fix this problem. When Congress created FSA as a performance-based organization in 1998, it gave the organization all the flexibility necessary to get the job done. And in return, the statutory expectation was that FSA would be transparent and that Congress would hold it accountable. When FSA testified before this committee not too long ago in November of 2015, I said that Congress created this PBO and then walked away. I said we, Congress, didn't uphold our end of the bargain and pledged to continue with that oversight, and we have. Which brings me to my next point, perhaps addressing the elephant in the room. We're looking forward to speaking with the head of FSA today, but regrettably, he resigned 24 hours ago. That's too bad, because under statute, he was responsible to Congress for the operations of FSA, and we had questions. It's also a slap in the face to the millions of taxpayers who provided this gentleman with over $430,000, yes, $430,000 in bonuses since 2010. With an investment like that, they deserve better. That said, I'm pleased to welcome FSA's Chief Financial Officer here today. We sincerely appreciate you coming, and I recognize that you only had 24 hours to prepare. I also look forward to working with Secretary DeVos to address the shortcomings of the student aid program, including improper payments. In fact, I spoke with her yesterday, and her commitment to getting this right was very reassuring. I'm hopeful that as we look to swiftly appointing a new Chief Operating Officer and a permanent one for the federal student aid, that we will be able to work very closely together and address some of the concerns that the Inspector General has pointed out. Today, however, we're focused specifically on improper payments. And I look forward to figuring out how we'll really fix this problem. We need a meaningful dialogue, and we need to identify real solutions. And with that, I just again welcome all of you. I'll now recognize the ranking member, Ms. Demings, for her opening statement.
Thank you so much, Mr. Chairman, for holding this very important hearing on improper payments, and I also welcome our witnesses and thank you for being here with us today. Loan servicers have had a lamentable record of taking advantage of the students who rely on them. For too long, they did this with few repercussions from the department. But in 2015, President Obama's Department of Education, Treasury, and Consumer Financial Protection Bureau announced a joint statement of principles on student loan servicing. These principles were developed to address the poor customer service scores and rampant borrower abuse. This guidance instructed the department to consider the past performance of its loan servicing contracts. In one of her first official actions, Secretary DeVos rescinded that guidance. On May 19th, Secretary DeVos announced her intention to hire a single loan servicer that will be solely responsible for managing the nation's $1.3 trillion plus student loan portfolio and will be able to subcontract to other companies. Apparently, the Trump administration intends to hire a fox to guard the henhouse. The National Association of School Financial Aid Administrators serves 9 of every 10 undergraduates in the United States and has served the financial aid community for over 50 years. It recently reported that within Federal Student Aid Office, strategic planning is not happening as Congress intended. In May 2016, Government Accountability Office concluded that the Department of Education lacks comprehensive and comparable information on the nature of borrowers' complaints made to the departments and its contracted loan services, hindering its ability to track trends and address borrower concerns. In other words, the Department of Education was not capable of protecting student borrowers and preventing abuses by loan servicing companies. In response to the GAO report, the department agreed to evaluate existing and alternative performance metrics and compensation strategies as part of its ongoing student loan servicing procurement and reflect the results in future servicing contracts. Secretary DeVos seems to be retreating from that agreement and is moving the department back to the bad old days. I look forward to hearing from the witnesses about specific plans that are being developed and what action should be undertaken to ensure that student borrowers are provided the best services and loan services are given notice that the department will not tolerate further abuses. Thank you so much, Mr. Chairman, and I yield back.
I thank the gentlewoman for her opening statement. I recognize the gentleman from Alabama, Mr. Palmer, for his opening statement.
Thank you, Mr. Chairman, and I want to thank the witnesses for being here. This is an important issue. It was an important issue to President Obama in July of 2010. He signed a bill, the Improper Payments Elimination and Recovery Act, because it's a drain on our resources. Every dollar that we send out in improper payments is not just a dollar, it's a dollar plus interest because we're operating in deficit. So it puts a huge constraint on our ability to fund the legitimate functions of government. It's a concept that's easy to understand. An improper payment is any payment that was made improperly, including payments made to the wrong person for the wrong amount, to ineligible recipients, and without supporting documentation. As a matter of fact, in the GAO's report, 54% of the improper payments that were made were because of insufficient documentation and inability to authenticate eligibility. That's not a heavy lift to correct that. What's hard to understand is how the federal government reported $144 billion of improper payments last year, $11 billion of which was they didn't pay people enough, leaving $134.7 billion in overpayments. Since reporting began in fiscal year 2004, the federal government has reported $1.2 trillion in improper payments. And I would like to add again, Mr. Chairman, that would be plus interest. Unfortunately, the Department of Education, specifically the Office of Federal Student Aid, has tended in the same direction as the rest of the federal government in regards to increasing improper payments, and is a good place to start to dig into this growing problem. I'd also like to point out that in 2016, GAO found several examples of contract mismanagement that have led to confusion among the student loan services. GAO has specifically highlighted concerns over the quality of communications and unclear guidance from FSA to the servicers. Department of Education Inspector General is here to report for the third straight year the department is not in compliance with the Improper Payments Elimination and Recovery Act of 2010, as I pointed out, legislation that the President signed in July of 2010. By law, agencies are required to conduct risk assessments to determine if programs are susceptible to significant improper payments. Susceptible programs must report a statistically valid estimate of improper payments and other details about the causes and corrective actions taken by the agency. The IG has reported concerns about the methodology the department uses to develop the estimate. The IG has also reported that the department has not conducted effective risk assessments or used the risk assessments to appropriately designate programs. These failures are particularly concerning given the amount of money at risk. Last year, the department reported more than $6 billion of improper payments from just 2 programs, direct loans and Pell Grants. The Office of Management Budget has designated both programs as high-priority programs, which means they are among the 20 programs with the highest rates of improper payments in the federal government. However, the estimate that the department reports is based on flawed methodology. The department admits as much in its annual financial report, which says the department acknowledges that its alternative estimation methodology can lead to volatile, improper payment estimates. How can we understand the risk and taxpayer dollars at stake when the department is unable to provide effective estimates? The department needs to take responsibility for the taxpayer dollars vested in the agency and do better. The department reports that the improper payments are primarily a result of a failure to verify financial data and administrative errors made outside of the department. Correction, the problem is the department is responsible for the money. The department is responsible for developing effective processes. The department is responsible for ensuring that the schools and the students understand the process and that the process is not overly burdensome. We are here today to begin the process of helping the department to assume this responsibility since it appears unable to do so on its own. We can't begin to fix the growing problem of improper payments across the government until agencies follow suit, and I look forward to working with my colleagues to do so. Thank you, Mr. Chairman. I yield back.
I thank the gentleman for his opening statement. The chair recognized the gentleman from Virginia, the ranking member of the Subcommittee on Government Operations, Mr. Conley.
I thank you, Mr. Chairman, and welcome our witnesses today. Today's hearing examines improper payments at the Department of Education. It's a very important topic, one that this committee has done a lot of work on, not only Department of Education, but throughout the federal government. And we have reason to be concerned for a lot of reasons. The Department of Education Inspector General has repeatedly reported on the department's noncompliance with Improper Payments Information Act of 2002, the Improper Payment Elimination and Recovery Act of 2010, and the Improper Payments Elimination and Recovery Improvement Act of 2012. We must understand how the department can improve its evaluation and targeting of improper payments and how it fails to comply with the law, in this case, 3 of them. However, the more pressing issue at the Department of Education, and the one facing most Americans' checkbooks, is the unethical, abusive, and predatory actions of student loan companies themselves. The department distributes $125 billion in student assistance every year. With more than $1.3 trillion in loans on the books, it is, in fact, one of the largest financial institutions in the country. To manage the portfolio, the department contracts with student loan companies. Last September, the OIG issued a report that found multiple student loan companies, which were supposed to be assisting students, were actually accessing and changing student log-on information as part of a predatory scheme to access their accounts, change their regular mail and email addresses, and even intercept correspondence. Specifically, the IG reported that the process for logging on to the Federal Student Aid website was, quote, being misused by commercial third parties to take over borrower accounts, unquote. Sounds like stealing to me. In one case, the IG warned that student loan companies changed the mailing address, phone number, and email address for borrowers so that it would be difficult for the borrowers to be contacted by their loan servicers. Less than 2 months ago, on April 20th, the staff of this committee conducted a transcribed interview with the special agent in charge of this investigation and the IG's office. The special agent warned that these companies were, quote, controlling thousands of accounts or creating thousands of accounts and controlling them. In other words, the very companies that were supposed to be helping students as contracted by the Department of Education were, in fact, abusing their trust in an egregious way. In January of this year, the Consumer Financial Protection Bureau filed suit against Navient, one of the largest student loan servicing companies in the United States, alleging that it steered high-risk borrowers into plans designed for those with short-term financial hardships, misrepresented the consequences of non-renewal plans, and prevented some of the most financially vulnerable borrowers from securing the benefits of payment plans specifically intended for them. In response to documented abuse by loan servicers and a default rate of 1 default for every 29 seconds, the previous administration issued a memorandum requiring the FSA to do more to help borrowers manage and discharge debt. The new guidance put protections in place for borrowers by reducing the possibility that new contracts would be given to companies that had misled or otherwise harmed debtors. Unfortunately, the new Secretary of Education, Ms. DeVoe, has rescinded those directives and instructed the FSA to move forward with awarding contracts to companies that have current lawsuits against them or have admitted in court to their abuses and have been fined millions of dollars. The elimination of these important protections by the Secretary herself allows student borrowers to be charged up to 16% of the principal and accrued interest owed on loans unless they enter the government's loan rehabilitation program within 60 days of default. The Secretary also intends to shift to contracting with one loan servicer, which will potentially have subcontractors along with them. This policy would eliminate direct government oversight of many loan services. I'd like to know how this new policy will provide better customer service and rein in loan servicer abuse. From the announcement by the Secretary, it appears the Department will, in fact, have less oversight of the loan services, not more, in this new model. The rollback of these vital protections and financial oversight, combined with recently announced budget by the President, represent a unilateral retreat from safeguarding the best interests of students and borrowers. Budget outlines a $9.2 billion or 13.5% cut to the Department of Education. The administration would eliminate the Federal Student Loan Forgiveness Program for public service workers, limit student loan repayment options, and end federally subsidized student loans. The actions of this administration constitute, in my view, an assault on education and economic opportunity. Education is an investment. The government has a return on that investment. When we shortchange that investment by leaving students to fend for themselves against unscrupulous loan servicers or withdraw federal support for education, we diminish our expected return, the talented, well-educated workforce the United States so desperately needs in the 21st century as we move forward. With that, I yield back.
I thank the gentleman for his remarks. I'll hold the record open for 5 legislative days for any member who would like to submit a written statement. We'll now recognize our panel of witnesses. I'm pleased to welcome Mr. John Hurt, Chief Financial Officer for Federal Student Aid at the U.S. Department of Education. The Honorable Kathleen Tai, Inspector General of the U.S. Department of Education, welcome. And Mr. Judge Justin Drager, President of the National Association of Student Financial Aid Administrators, welcome, welcome back. Welcome to you all. Pursuant to committee rules, all witnesses will be sworn in before they testify, so if you'll please rise and raise your right hand. Do you solemnly swear or affirm that the testimony you're about to give will be the truth, the whole truth, and nothing but the truth? Thank you. Please be seated. Let the record reflect that the witnesses answered in the affirmative. In order to allow time for discussion, we would appreciate if you would limit your oral testimony to 5 minutes. However, your entire written testimony will be made part of the record. Mr. Hurt, you're recognized for 5 minutes.
Thank you, Chairman Meadows and Palmer, Ranking Members Connolly and Butler-Demings, and members of the subcommittees for the opportunity to join you today. My name is Jay Hurt, and as the FSA CFO, I am the program accountable official for improper payments at federal student aid. I'm here to talk to you about improper payment estimates for the Pell Grant and direct loan programs, the most recent audit of the department's compliance with IPERA, and our work to minimize the level of improper payments in these two programs. As the largest source of student aid for post-secondary education in the United States, FSA delivered more than $125 billion in aid to more than 13 million students attending more than 6,000 schools last year. FSA must balance the simplicity and efficacy of the federal student aid delivery process with the need to protect taxpayer dollars. This balance has led us to create a highly automated and integrated aid delivery process with hundreds of controls to combat improper payments. We appreciate the partnership with our IG, looking for opportunities to improve this process. In 2014, OMB approved our alternative improper payment estimation methodology for Pell Grant and direct loan programs. This methodology leverages data collected through FSA program reviews, avoids significant costs that would otherwise be required for separate testing at schools if FSA were to use statistically sampling techniques, and integrates the improper payment estimation into core FSA monitoring functions. In June 2016, FSA submitted updates to the alternative methodology to OMB in response to findings from the IG's fiscal year 15 IPERA compliance audit report. OMB approved the revised estimate methodology in October of 2016. As a result of the changes to the methodology and as a likely result of the inherent variability of the methodology, the fiscal year 16 estimated improper payment rates for the Pell Grant and direct loan programs increased over the estimates produced in fiscal year 15 and were higher than the targets set in fiscal year 15. The improper payment rates are primarily based on the assessment of completed program reviews. Schools are selected for a program review based on risk-based criteria. Only a small set of schools are selected for review randomly, typically less risky schools. Because all schools are not randomly selected for review, the extrapolation of findings from these reviews does not produce an estimate that is representative of the full population of payments. In order to eliminate the variability of the estimate to the tolerance level prescribed by current OMB guidance, FSA would need to spend millions more on its improper payment estimation process and impose significant burdens on roughly 1,000 schools. If FSA were to divert resources from the higher-risk program reviews to the randomly selected reviews, we would essentially be giving up the identification and recovery of improper payments in order to improve our estimates. Although fiscal year 16 IPERA compliance audit report identified the department as non-compliant with IPERA due to missing its improper payment reduction targets, the IG found that the department's improper payment reporting, estimates, and methodology were generally accurate and complete. FSA has developed robust internal controls to prevent, detect, and where appropriate, recover improper payments. In designing controls, FSA strives to strike the right balance between providing timely and accurate payments to students and ensuring that controls are not overly costly and burdensome. In fiscal year 16, FSA documented and assessed 328 controls to detect and prevent improper payments and found that 97% were designed and operating effectively. FSA has also identified corrective actions to address the root causes of improper payments. For example, FSA annually reviews verification procedures that require schools to verify specific information reported on the FAFSA form by student aid applicants. These school verification procedures are an effective control, avoiding hundreds of millions annually in actual improper payments. Despite our continuous efforts to reduce improper payments, it would be misleading for us to leave Congress and the public with the impression that 0% improper payment rate is feasible. In its 2016 Global Fraud Study, the Association of Certified Fraud Examiners found that the typical organization loses 5% of revenues in a given year as a result of fraud. As currently defined by OMB, improper payments include much more than fraud. Using this definition, FSA's estimated combined fiscal year 16 improper payment rate is 4.85%. I appreciate the opportunity to provide you with this information, and I welcome any questions you have.
Thank you, Mr. Hurt. We now recognize you, Ms. Ty, for 5 minutes.
Thank you very much. I apologize for my voice this morning. I'll try to speak louder. Thank you for inviting me here today to discuss the work of the Department of Education Office of Inspector General involving improper payments. Our work related to improper payments has evolved and increased over the years with the passage of several statutes, including the Improper Payments Elimination and Recovery Act of 2010. In these efforts, where we have identified instances of noncompliance with IPERA by the Department and weaknesses in the Department's efforts to measure, estimate, and report on improper payments, we have provided recommendations for improvement. In our recent improper payments audit covering fiscal year 2016, we found for the third year in a row that the Department did not comply with IPERA. Like the previous 2 years, the Department did not meet the annual reduction target for the direct loan program. This year, it also did not meet the annual reduction target for the Pell program. The improper payment estimate for the Pell program was 7.85%, or $2.21 billion, which exceeded the reduction target of 1.87%. The improper payment rate for the direct loan program was 3.98%, or $3.86 billion, which exceeded the reduction target of 1.29%. This was not unexpected, as in response to my office's recommendations, the Department had revised its estimation methodologies for both the direct loan and Pell programs to include estimates of inaccurate self-reported income and improper payments associated with ineligible programs and locations. The Department also expanded the number of program reviews it used. Although these revisions to its methodologies caused a significant increase in improper payments for both programs, tripling the estimate for the direct loan program and quadrupling the estimate for the Pell program, the increased rates show the progress the Department has made in its estimates and provide a more realistic picture where these programs are in terms of improper payments. This should result in better information for the Department to use when designing appropriate corrective action. Our recent audit also found for the first time that the Department did not conduct risk assessments that conformed with the appropriate requirements to determine whether Department-managed grant programs and FSA-managed contracting activities may be susceptible to significant improper payments. Through its own risk assessment, the Department identified the Rehabilitation Services Administration Vocational Rehabilitation State Grants Program as a program that exceeded the established improper payments threshold. Single audits reviewed by the Department had identified question costs for the VOC rehab program ranging from $31 million to $44 million, which are between 1.56% and 1.81% of program outlays, all over the threshold. Yet despite these findings, the Department did not conclude the VOC rehab program may be susceptible to significant improper payments and did not report the program in its fiscal year 2016 annual financial report as it was required to do. Further, for FSA-managed contracting activities, the Department did not consider 7 of the 9 required risk factors. FSA-managed contracting activities accounted for 76% of the Department's active contracts in 2016. For the Department-managed grant programs, the Department did not consider 2 of 9 risk factors. As a result, these risk assessments did not comply with IPERA. Based on our findings, we made 10 recommendations to help the Department comply with IPERA and improve its improper payments reporting, estimates, and methodologies. With the exception of our recommendation pertaining to the VOC rehab program, the Department indicated it will take action to respond to our recommendations. This concludes my testimony. I'm very happy to answer questions.
Thank you. Mr. Drager, you're recognized for 5 minutes.
Mr. Meadows, Mr. Palmer, Ms. Demings, Mr. Connolly, thank you for the invitation to testify today. As has been pointed out, NASFA represents financial aid administrators at 3,000 public, private colleges, universities, and trade schools across the United States. Financial aid administrators really sit at the nexus between policy and practice, and so we like to believe that our perspective can add value as how things that emanate from Washington, D.C. affect students on the ground. An improper payment can be the result of fraud, or it can be the result of error. And from an institutional perspective, we've made some progress on both of those fronts in recent years. Concerning fraud, some of the most recent institutional practices that have been implemented to combat fraud include more stringent academic progress monitoring to make sure students are moving through their program, with help from the Department of Education, tracking students who are attending multiple institutions, smaller disbursements made to students on an ongoing basis, more in-depth one-on-one counseling, and more faculty involvement to track attendance to make sure students are actually attending the courses they're taking financial aid for. But one of the greatest challenges in dealing with improper payments within the student aid programs is really in our efforts to drive down improper payments, we don't want to simultaneously and sometimes inadvertently drive out the very students that we're trying to help. So I want to offer two real-life contrasting examples of, that have come up in recent years. First, as has been pointed out by the other folks on the panel, one of the root causes of improper payments is unverified financial data from an applicant that is put on their financial aid application. To correct this issue, the Department of Education, the IRS, several years ago implemented an IRS data retrieval tool, which was really a win-win because it allowed students to automatically import their data, automatically verified by the IRS into their application, lowered barriers for students, and decreased improper payments. As folks on these subcommittees are aware, though, in an unfortunate twist, that tool was taken down in March because it detected fraud. And without that tool being operational and securely operational, improper payments will likely increase and students will have larger than necessary barriers in completing their applications. Still, though, the DRT is a good example of a tool that automated a process to lower improper payments and serve students and families. On the other hand, sometimes when we try to drive down improper payments, students and schools are subjected to very burdensome regulations and requirements that have pretty questionable outcomes and results. For example, the department found that 15% of all financial aid applicants who said they did not file a tax return actually did end up filing a tax return. And on the face of it, that sort of error is disconcerting. So the department began requiring students to provide documentation from the IRS that they did not file a tax return. As it turned out, that process was ridiculously complex and archaic and required 10 business days for students to request a transcript from the IRS through the U.S. Postal Service. In 2015, 2016, 2017, that sort of archaic process can, at best, delay financial aid, and at worst, as schools reported, disrupt enrollment. And the one unanswered question on all of this is, did any of the changes that resulted from this requirement actually reduce improper payments? That question was not answered, at least publicly, to the institutions that had to implement this for students. Unfortunately, a solution that was under consideration, where the IRS and the department would just behind the scenes through a database match automatically determine whether somebody had filed a tax return, has since been scrapped. I want to offer in my last minute here just a few suggestions. One is that we would like to encourage the department to continue to leverage technology whenever possible, to take the burden off of students and rely on other federal or state databases as much as possible to verify student eligibility. This has to be done, of course, securely. Second, we need a better partnership with the Department of Education to work closely together so that any new requirements or data collection requirements go through some sort of testing first so that we understand the impact on students and schools. Audit and program reviews must be issued in a timely way, and the department should consider a voluntary program where schools can come forward with errors without fear of reprisal, fines, and liabilities in the spirit of partnership to fix improper payments. And finally, we need congressional help to simplify everything from the application to the formula determining student eligibility. Thank you for your time, and schools stand with you in wanting to ensure the right dollars are going to the right students.
Thank you all for your testimony. The chair recognizes the gentlewoman from North Carolina, leader in educational issues, Dr. Fox, for 5 minutes.
Thank you very much, Mr. Chairman, and I want to thank our witnesses for being here today and providing testimony on this very, very important issue to so many to all Americans. When you hear about a $3.86 billion in fraud, that affects every person in this country, not just the people who are applying for financial aid. Mr. Hurt, FSA testified before this committee earlier this month on the suspension of the FAFSA's IRS data retrieval tool, the DRT, which Mr. Drager referred to. That tool is touted for curbing improper payments by providing for more accurate financial data reporting by applicants. In response to the DRT being down, new flexibilities were announced by the Department on April 24 for borrowers, including removing the requirement for institutions to collect documentation for verification of non-filing applicants. How is the Department balancing these flexibilities while also attempting to improve its improper payment rate management? And do you expect improper payments to rise given the Department's reliance on manual reporting and back-end verification during the DRT suspension?
Thank you, Congresswoman Fox. Yes, we do. During the DRT actually assisted. It was a win-win situation. It assisted with the reduction of improper payments. It reduced burdens on schools, and it reduced burden to applicants. While we are working on the security of the tool, we are providing alternative means, information about alternative means to obtain your tax information. We did provide some relief to schools around the verification requirements, and we do expect that there will be some impact on improper payments. That's a given. That's what the DRT was meant to do. But we are trying to balance, to your point and the point of Mr. Drager, we're attempting to balance the burden on schools and the denial of service to the most needy with the offsetting the improper payments that come.
Thank you. You know, you said earlier that 0 mistakes is unrealistic. That's not what the American people expect out of their government, especially, again, when you're dealing with the money of hardworking taxpayers. And so I find it very, very frustrating when you say we can't have a program. I don't use an ATM card, but the banks have ATM machines. I'll bet their improper payments are a whole lot lower than the improper payments of the Department of Education. And I think we should strive for 0 mistakes. You're not dealing with your own money. You're dealing with somebody else's money. And I want the people in the department to remember that every day. So going back to that, the Inspector General has flagged improper payments as a management challenge every year since 2012. But during that time, OMB has designated the programs as highly susceptible for significant improper payments. What concrete steps have you taken to reverse this trend, whether it be combating fraud or reducing human or systemic errors? Why haven't they worked? And what is so wrong with your office that you can't move in a more timely fashion?
For the past 3 years, we have been non-compliant with IPERA. The non-compliance is based on the fact that we have missed our estimates, our targets, and there's a number of reasons for that. One of them is the fact that we've been changing the methodology to address the findings from the IG. The IG has given us, in 14 and 15, fiscal year 14 and 15, they gave us 19 recommendations, and we did implement all 19 to improve our estimates. Part of the issue is, though, the variability of the issue of the estimates and the need to increase cost to the taxpayer and burden on schools to be able to improve on the estimate. It would be a significant burden on schools and cost to taxpayers simply for the improvement of the estimate. Instead, we spend more effort and money on an annual basis on the actual improvement of the controls themselves. So for example, this past year, we implemented what was referred to as early FAFSA and prior. That was a change to the FAFSA that it was done earlier and allowed applicants to utilize prior tax payment information that was already complete. And both of those things allowed them to be more accurate in their filing and didn't require them to come back and file kind of corrections. So what that did was improved our improper payment, as actually the controls over real improper payments as opposed to just the estimates.
Thank you. Mr. Chairman, I know my time has expired, but I would like to say I will be submitting some questions to some of the panelists for their response. Thank you, Mr. Chairman, for your indulgence.
I thank the gentlewoman, and as we have those questions, we'll give each of you 30 days to respond to those and get it back to the committee. The chair recognizes the gentleman from Virginia, Mr. Conley, for 5 minutes.
I thank the chair. I thank our panel for being here, and I certainly agree with my friend, Ms. Fox, that the goal should be to strive to move to zero in terms of improper payments. Depending on how one counts, there are $150 billion of improper payments federal government-wide every year. That sound right to you, Inspector General Tai? Around that? But if you were to stretch it out over a 10-year period, and if we could ever get it close to zero and dedicated just, the savings to deficit reduction, it would be a good down payment.
It would be.
And it wouldn't cut any programs, and it wouldn't raise any taxes. So the more efficient we can get, the better off we're going to be from a fiscal point of view and the discipline of efficiency. So I agree with Ms. Fox in making that point. Ms. Tai, I began by citing your report that consistently the Department of Education has failed to comply fully with the Improper Payments Information Act of 2002, the Improper Payments Elimination and Recovery Act of 2010, and the Improper Payments Elimination and Recovery Improvement Act of 2012. Is that accurate?
That is accurate.
Mr. Hurt, why is that the case? These are the laws.
Over the years, we have taken the recommendations from the IG and modified the methodology. That's one of the reasons why the rate differs from the actual target. The way the IPERA works, we cannot go back and modify the target when the methodology changes. So as we've become more inclusive of our estimates include looking for more risks in the estimates, and they grow. The targets don't grow. Therefore, when we miss the targets, by definition, we're non-compliant. So that's one reason we've been non-compliant. And the other is just the nature of the estimate we base it on existing work and monitoring work within the federal student aid. So that monitoring work is a targeted, most of our work is targeted to high-risk areas, and it's not randomly selected. We do that because we want to find improper payments. We want to find opportunities to fix.
Ms. Tai, I'm sorry because I'm running out of time. Ms. Tai, do you agree with Mr. Hurt's explanation for why they're not in compliance, the department's not in compliance?
Well, yeah, for the most part, I would say that until this past year, our recommendations made in our peer reports weren't always necessarily followed by the federal student aid. That changed this past year when they did take our recommendations from our 14 and 15 reports, which were very similar in findings, and decided to, I think, do better root cause analyses, and then also plot out a strategy for dealing with those. I do think federal student aid is in a better place right now than it was a couple of years ago.
Okay, I'm going to run out of time, so let me get to, that's good to hear. Let me get to this issue, though, of private companies engaging in clearly unethical, if not illegal behavior. How widespread is that? And what is the relationship between that behavior and improper payments?
Well, I think we've certainly seen the issue. You saw you mentioned the report that we did last summer. We consider it to be a problem that keeps reoccurring. I think the relationship to improper payments is not all that clear. It's certainly bad behavior, and what I would worry about, it's really for the borrowers' accounts who are taken over. And I think there could be a relationship between, which do not affect the direct loan and Pell programs directly, but the fact that they're cut off sometimes from their own servicer and not able to make good choices on their loans is a problem.
Mr. Hurt, why wouldn't the department just cut off any company that engages in that kind of behavior? Why would we continue to contract with a company that is clearly behaving, I would argue, illegally?
I probably should draw a distinction between that activity, which is done by third-party providers, and the loan servicing companies that contract with the Department of Education. The findings around third-party providers are not our loan servicing companies. They can be unscrupulous actors, and we are cooperating fully, actually collaborating with our IG colleagues to identify bad actors in those scenarios and take actions and put in controls to avoid that from happening.
My time is up, but I see Ms. Tai wanted to comment on that, and then I'll be done.
And I want you to comment on that.
Yeah, thank you.
Thank you. Mr. Hurt is correct, is that we are talking about in our report, and what I was just talking about, are third party, they're really people pretending to be, companies pretending to be loans consolidators. The loan servicers who the department contracts with are different than that. But nevertheless, these bad actors need to be dealt with. And we did our report, and we made really two major recommendations, because we'd like to be able to prosecute some of these people. And one of those things was a simple, very simple fix of changing the banner, the login banner on the website. And we made that recommendation a while ago now, and I'm happy to say that I think FSA just implemented it, I think, last week, and that's a good thing. But
When did you make that recommendation?
it was September a year ago, I think. And I could be wrong on that, so let me check on that.
No need to rush into these things, Mr. Chairman.
Yeah.
Okay, well, this whole area of the topic we're going to pursue, perhaps in some subsequent questioning, but I thank you all for your testimony, and thank you for your indulgence, Mr. Chairman.
I thank the gentleman for his insightful questions. Before I recognize the chairman of the subcommittee, I want to recognize a delegation that came in from the European Parliament Committee on Budgetary Control. I want to welcome you from across the pond and say thank you for being here, and certainly for your willingness to share your ideas and allow us to share ours. So welcome. And with that, I recognize the chairman of the subcommittee, the gentleman from Alabama, Mr. Palmer.
I'd like to welcome the members of the European Parliament as well. Now to get back to business, FSA did not meet 3 of its performance goals, Mr. Hurt, 2 of which specifically related to customer service. There are only 2 performance metrics that evaluate customer service, so FSA did not meet either of its customer service goals. What is causing this failure?
So the goals that you referenced, one was the American Customer Satisfaction Index. That is it's a way that we can measure customer satisfaction that is consistent with what many.
My question is what caused the failures? So I don't need a description.
Sorry.
And not to be rude, but just for sake of time, please.
So the causes were twofold for the ACSI score. One was there was a methodology change. To be more consistent with the way the score is calculated with others in the industry, we switched to it was either from phone to an email interaction. I think that's the way it went. That was one way, cause. Another cause was most likely things associated with changes to the way we work. For example, we implemented FSAID to improve security, and that more than likely had an impact on satisfaction as well. So we had to back to that trade-off of ensure some security for our applicants and the folks, the customers that use our service. But it was at the detriment to some extent to the satisfaction and ease with which those good actors can use it.
To what extent do you consider how you can improve service to help reduce administrative errors by others that cause improper payments? So when I look at the GAO report on where most of these improper payments occur, and this may or may not apply to in this situation, but it's just insufficient documentation, the inability to authenticate, process errors. I think that's what we're talking about now. So,
The bulk of the errors, or probably the most significant, is around errors of eligibility. So it's misreported income or misreported other aspects on the application. That's what the DRT helps us greatly with. It does help us with the misreporting of income. In addition to DRT, school verification can be very helpful in identifying mistakes in eligibility. So that's where a lot of our focus is on that.
When you talk about misreported income, Mr. Drager, how much of that's fraud? I mean, in your testimony, you mentioned that student fraud ring activity had increased 82% from 2009 to 2013. How much of that's fraud, and how much of an ability do we have to catch that?
It's difficult for me to give an exact percentage of how much is fraud versus just honest mistakes. What we will say, what we see on campuses are that those who are interested in committing fraud have a very specific and targeted way that they pursue their fraudulent activities. And in recent years, schools have found ways to then defend against that sort of fraud. A lot of times when it comes to improper payments with income reporting, it appears to be honest mistakes, confusion about which tax years students or families should be using. So to the extent that this can be automated and we can get a secure IRS data retrieval tool back working, that seems to be one of the best solutions.
General Ty, you want to comment on that?
Yes, I do. I would just point out one thing we need to keep in mind is the DOT is a fine tool. We would totally agree with that. It is not going to catch fraud, because people who want to defraud the government, the fraud rings we were talking about, based on usually representing your income to be zero, they aren't using the DRT. So it's not going to help with that.
So the checks go directly to the fraudsters and not to the schools?
Well, the checks, yes, will go to the credit balance. The balance that doesn't cover tuition and room and board will go to the students. And to and the students really aren't students, they're fraudsters.
Getting off maybe just a little bit, if the chairman will indulge me, is there instances of fraud where there are fake institutions? I mean, we've had this with Medicaid, where there were people filing for Medicaid reimbursements and they were non-existent entities. Does that happen in this case, General Ty? Do we know of any of that?
I'm not aware.
Okay. Let me ask you one other quick question. In your fiscal year 2016 audit, finds issues in departments reported estimates and methodology. What did you specifically find with regard to challenges with the estimates?
Specifically, we found a couple of things, which were that they included some program reviews that weren't geared toward finding improper payments. So they would deal, like there was one that dealt with a cohort default rate. So that should have been excluded from the sample of program reviews. And there were issues like that. We did recalculate the improper payments rate estimate, and those, correcting for those mistakes, really only made a marginal increase in the improper payment rate, so we did not consider them to be hugely significant errors, but they were errors that they need to deal with.
Thank you. I yield back.
I thank the gentleman. The chair recognizes the ranking member, Ms. Demings, for a generous 5 minutes.
Thank you so much, Mr. Chairman. Inspector General Ty, back to your report from March of 2016. I believe the report pretty much found that the department knowingly misled the public, that they misled the public about the findings in its own review of loan services and potential widespread abuses, including charging active duty service members high interest rates on student loans. Your probe found that one of these companies, Navient, charged nearly 78,000 members of the military interest in excess of the 6% cap permitted by a law specifically designed for service members. Is that pretty much correct?
That's correct.
Navient continues to service loans for the department today. Is that correct?
Yes, that's correct.
Okay. I'm wondering if this company, considering its history, may be too big to fail. I'm wondering if, no matter what the abuses, the Department of Education will continue to contract with them. Last week, Secretary DeVos laid out her vision of the loan servicer model. As we all know, the loan servicer model allows the one prime contractor to subcontract out portions of the portfolio or manage the whole itself. Mr. Hurt, currently, 4 loan services have submitted proposals for the opening bidding process: Navient, Fed Loan Servicing, and a combination of Nelnet and Great Lakes Educational Loan Services. Is that correct to your understanding?
It is.
Can you explain the separation between the procurement arm of FSA and the management side, and who is going to make the determination as to the award of the contract?
It's my understanding ultimately that the contracting officer is the one with the warrant, so they will make the final decision. But it'll be based on a recommendation from a technical evaluation panel and a cost evaluation panel.
Can you explain the separation between the procurement arm of FSA and the management side?
The procurement, the acquisitions office is an office within federal student aid. So they report, the head of acquisitions reports directly to the chief operating officer.
Reports directly to them.
Yes, ma'am.
Okay. It seems that one loan servicer under contract managing the entire portfolio, the department would have no recourse if the servicer commits any number of abuses we have spoken to today. It will be maybe too big to fail. How will this huge, in fact, it appears that there are subcontractors under the loan prime contractor. The subcontractors will be the only accountable to the prime, leaving the department with even less oversight than it has today. Would you agree with that, or no?
No, ma'am. We have the re-release of the modification for the procurement has thousands of requirements and has performance metrics that we'll use to hold any new servicer accountable for their role. Any subcontractors that report to the prime, that is a relationship between the prime and the sub, but we will hold the prime accountable for all metrics and all service that they provide for borrowers.
Okay. Check my time. President Trump proposed a $9.2 billion or 13.5% cut to the Department of Education. How will this huge cut affect the department's ability to oversee these services?
The department just issued their budget a few days ago. That's something that we have yet to analyze it from an operational trend.
So you're not sure how the cuts, the 13.5% cut, will affect your ability to oversee this process? Not yet.
I'll have to take that question and get back to you.
Okay. Ms. Ty, given your experience over the last 7 years, are you confident that the department can cut its funding and simultaneously improve the management of its largest contract in the history of the department?
Well, I think budget cuts that would cut resources, let me back up. One of our management challenges historically has been oversight and management of the various entities that the department has to oversee and manage, whether it's contractors or grantees. And I think that it's going to be a challenge for the department if resources are cut in those areas to maintain a level of sufficient monitoring and oversight that is needed.
Thank you so much. And Mr. Chairman, thank you for your generous 5 minutes. I yield back.
I thank the gentlewoman. The chair recognizes the gentleman from North Carolina, Mr. Walker, for 5 minutes.
Thank you, Mr. Chairman. Again, welcome to our guests across the Atlantic Ocean. We're always happy to see you guys. Mr. Hurt, as the Chief Financial Officer now, I know you haven't had a lot of time to prepare, but I've got a few questions, specifically on the data retrieval tool. It's been offline since March the 3rd, 2017. Do you expect it to be offline for financial aid filing purposes until October, or when?
The data retrieval tool will come up with a mass encrypted solution for the 1819 FAFSA on October 1st. That's when the cycle starts for 1819.
Okay. And how does the outage affect improper payments for calendar year 2017, this year?
For calendar year 2017, we would expect that the improper payments will increase related to the lack of DRT being available, or DRT not being available.
So, I mean, your best word on record is that these improper payments will continue to increase until basically this is back online. Is that correct?
They will, the portion of improper payments that the DRT was actually helping us to avoid will, for that period of time, be until October 1st for 2017-18. Unfortunately, the improper payments will increase.
So, yes, that's painful to hear. The department announced new flexibilities for schools working with students given the data retrieval tool outage. Can you talk about these new flexibilities? What were they?
For schools, they specifically, I believe, the school verification on income, it was the old requirement, or the requirement normally is to get a specific tax transcript from the IRS, and now we will require a signed tax form, essentially.
Okay. What do you propose, or how will the Office of Federal Student Aid ensure that improper payments do not suffer during the DRT outage? Do you have any advice? I mean, what are we to do in the meantime?
We are, one of the things we can do, and we've been working on, is to increase our communication through our numerous channels to the applicants to help them use these alternative ways to get their tax information. We do that through our studentaid.gov. We do that through social media. We do that through our communication and coordination with student advocacy groups. So we're using multiple avenues to attempt to train or assist the applicants in this period.
I guess time will tell how successful those options are. Inspector General Ty, first of all, thank you for being here. Probably not feeling your best today, but I'm glad you're being such a trooper today. This week, news broke that the data retrieval tool was misused in a criminal personal manner in September of 2016 by a Louisiana man who was targeting personal information on Donald Trump. Can you confirm this reporting?
Yes.
Okay. The data retrieval tool is clearly a valuable tool to federal student aid to assist with ease of processing for students. We know that. And also to program integrity measures such as curbing improper payments. However, the data retrieval tool is without a doubt also a high-value target for cyber criminals. How do we strike that balance, the right balance between program integrity, efficient service to students and schools, and then also the cybersecurity concerns?
I should point out that in the matter you spoke about with the criminal case involving the misuse of the DRT to try to get the president's information, they were unsuccessful in achieving that. They did not have enough information to trigger access of the AGI available. And I'm also happy to say that it was noticed by the IRS, and they immediately brought it back to us, and and that resulted in somebody's arrest and then prosecution, which is a good thing.
Sure, thank you.
I think it's an important tool, but I do think it's good that the department and the FSA are looking at ways of keeping the tool viable, but still protecting it against its misuse. I mean, the masking will help the DRT misuse problem, but we also have to stay one step ahead of the bad guys, right?
Yes.
Because, you know, they're always thinking of things, and we would also like to see the department, it was a recommendation that was in our report that Ranking Member Demings noted, was they need to do more proactive analytics related to usage on the FAFSA online, and because there were patterns that I think they could have seen of bad guys.
Thank you, General Ty. Appreciate your words. Mr. Chairman, I yield back.
I thank the gentleman. The chair recognizes the gentlewoman from the District of Columbia, Ms. Eleanor Holmes Norton.
I thank the chairman for this hearing. And I'm interested in the issue of accountability, because we're not dealing with a new issue, although the Inspector General report came out in September about the misuse of the department's own systems to take advantage of students. Now, the students are going to be under a lot of pressure because of substantial cuts to subsidize student loan programs that at least are being proposed. Certainly hope the appropriators do the right thing, though. The Inspector General's report was fairly emphatic that the systems were taken advantage of, the department systems were taking advantage of. Then the Consumer Finance Protection Bureau, and I believe jointly with the department, did a public inquiry, and then they found a plethora, a huge number of complaints regarding loan services. I do want to quote the finding. They found a huge number of complaints. The department itself, it already had the Inspector General's report, but the finding was current serving practices may not meet the needs of borrowers or loan holders. What does that mean? Seems a modest way to frame what has been under discussion at this hearing. What does that mean? May not meet the needs of borrowers or loan holders. Mr. Hurt.
I'm not sure, Congresswoman Norton, I can speculate what about the meaning of that particular phrase.
Well, it was an inquiry, joint inquiry by the Consumer Products Bureau, Protection Bureau, and the department. So that's why I'm asking you what you meant to say. I'm interested in accountability here.
As for, if it relates to the servicer practices and the work to improve servicer practices, the modification that just came out for the loan servicing competition, again, it includes requirements, many of which are requirements or suggestions that have been made to us to improve borrower outcomes. So we expect that the outcome of this procurement will in fact have significant improvements to borrower outcomes, and while still balancing the cost to taxpayers.
Thank you, Mr. Hurt. Now, the consumer product uh, the Consumer Financial Protection Board has filed a suit against your largest servicer, Navient, with rather strong and serious allegations that it withheld information about income-based programs, and then that they could have lowered borrowers' monthly payments, and then pushed borrowers into forbearance, while, of course, they were continuing to accrue interest. Are you familiar with the allegations of the Navient lawsuit?
I am familiar with the allegations.
The reason I ask, because I don't expect you to comment on those allegations, the reason I ask is that apparently you had 9 borrowers before, and there's a proposal to have only 1 borrower now. Why would you want to go down to 1 borrower? And that could be Navient, which is, of course, the biggest of them, and the one that's now ensconced in litigation.
We're looking at the new modifications to the procurement are looking at one loan servicer so that with a more robust set of requirements and performance metrics that we can hold that servicer accountable. So the procurement is actually meant to improve service. But part of the issue of having multiple servicers is it also spread the oversight out a bit thinner.
Was there any competition between them, among them?
The incentives structure for the previous for the 4 or for the previous servicers, there was based on there was competition associated with, or allocations were made based on metrics, allocation of new servicers. So there were incentives in that previous procurement. In the one we're looking for, we also are looking to have metrics and adjust metrics to address many of the borrower outcomes that we're seeking and were recommended to us.
Well, I recognize that there are a number of, there's a competition, and that there are a number of applicants for this role, but I think the department will be under very severe pressure if Navient, in the sconce of being involved in a lawsuit, is made in charge, essentially, as the prime contractor of all the subcontractors. And I thank you, Mr. Chairman.
I thank the gentleman. The chair recognizes the gentleman from Ohio.
Thank you, Mr. Chairman. Today's hearing highlights exactly what American taxpayers hate about the federal government. Ms. Ty, isn't it true that last year there were $144 billion in overpayments, or excuse me, improper payments across the government? Isn't that accurate?
That sounds accurate.
Yeah, and the trend is up, right? So that number's been growing.
Yes.
Growing over the last 4 years.
Yes.
And one of the most egregious agencies that is part of that overall number is the guy sitting beside you, the Department of Education. Is that correct?
Well, it's not
In the top 5, right?
I think top 5.
Yeah, top 5. And the trend is the same with them. Overpayments have been increasing over the last several years. Is that right?
Yes,
in
certainly
both,
this past year.
Yeah, in the direct loan and in the Pell Grant areas, they've both been trending up. And you sent them a letter where you said something like there was a management, they had improper payments at the department were a management challenge. Is that right? You sent a letter to them?
That's correct.
Yeah, and it basically said they weren't complying with the law, right? This IPERA law?
Correct.
Yeah, so $144 billion across government. One of the most egregious agencies within that $144 billion is the Department of Education. Their trend is up. You sent them a letter saying, hey, get your act together. You're not even complying with the law, right? That's all
Yes.
that's true?
Yes.
And 3 weeks ago, we had a hearing, and we find out that in the direct loan program, they had to shut down their DRT on the FAFSA issue, and they failed to comply with another law there to notify Congress in the proper way and at the proper time. Is that true?
Well, the notification, I think, may be a more ambiguous issue, but...
Exactly. Yeah, we had that hearing 3 weeks. So this is now 2 hearings in a row this committee has had where the Department of Education has not complied with 2 federal laws. And, oh, by the way, the increase in improper payments continues to rise. And here's the kicker. Mr. Hurt, your boss, the guy we asked to come Mr. Runcie. You know Mr. Runcie? Mr. Hurt, do you know Mr. Runcie?
Yes, sir.
Yeah, and he was your boss?
Yes, sir.
Yeah, and he was asked several times to come in front of this committee and talk about this situation. Is that true?
Yes.
Yeah, and instead of coming in front of this committee, what did Mr. Runcie decide to do? Do you know?
Mr. Runcie resigned.
Resigned, yeah. The night before, right? He's supposed to come, the night before we were going to send him a subpoena, he decided to resign. You know why he would do that, Mr. Hurt?
I can't speculate for Mr. Runcie.
How about you, Ms. Ty? You know why he might do that?
I do not know.
Mr. Hurt, did Mr. Runcie receive any bonus payments over the last few years for his stellar job of not complying with 2 federal laws, improper payments that continue to increase and have increased over the last 3 years? Did he receive any bonus payments for his job performance?
I think the chairman referenced bonus payments. I personally don't have, I'm not involved in Mr. Runcie's bonuses.
Yeah. How about Ms. Ty? Did he get some bonus payments?
I'm not aware of Mr. Runcie's bonus payments either, I'm sorry.
Yeah, well, it's our understanding that there were several $1,000s. Last year alone, $75,000 bonus. Ms. Ty, do you know if Mr. Runcie was at the top of the federal pay scale?
I do not know that.
Yeah, my guess is he was at the top of the federal pay scale, got a $75,000 bonus last year, and over the last 6 years, bonuses totaling $432,815 for a guy who can't comply with 2 laws, is asked to come testify in front of this committee. And instead of coming and testifying in front of this committee to answer for what took place at the Department of Education, one of the most egregious agencies in overpayments or improper payments, instead of doing all that, he just decides to resign on the spot. Man, that's amazing. No wonder the American taxpayers are fed up with our federal government and the way this place operates. I think, Mr. Chairman, we should have Mr. Runcie in here. I think we should go ahead and subpoena the guy and bring him in here to answer some of these questions. I mean, again, you just walk through it. $144 billion across government. The agency that's maybe one of the most egregious offenders of overpayments is the Department of Education. 2 laws they don't comply with. That trend is going up. The guy who's responsible is asked several times to come in front of this committee, and instead of coming in front of this committee, he up and resigns. And to add insult to injury, he's been receiving bonus payments the last 6 years that total $432,815. This is amazing. That's why we have this. This is why we have this committee, to get to the bottom of these kind of things. But Mr. Runcie should be in front of the committee. And frankly, whoever was responsible, my guess it was Mr. Duncan who was responsible ultimately, the former Secretary of Education, in allowing these bonus payments to be given to Mr. Runcie, should be in front of this committee as well. Say, why was he given this kind of bonus at taxpayer dollars when there's billions of taxpayer dollars that go unaccounted for that are under his watch? So, Mr. Chairman, with that, I would yield back the balance of my time.
I thank the gentleman. Mr. Hurt, let me follow up one quick question. I mean, don't you think Mr. Runcie could have illuminated some of the questions that you've been unable to answer today? Do you think he would be the appropriate person to answer some of these questions?
Chairman Meadows, I can't speak to.
But don't you work for him?
I did.
Okay. So wouldn't he have some knowledge of improper payments?
He would have some.
It's a softball question, Mr.
Yes,
Hurt.
sir.
I'm not trying to trap you.
He would have some knowledge of improper.
And so shouldn't he have some, I guess, responsibility to come before Congress and help us understand why the record is so deplorable?
That's for Mr. Runcie to answer, not me.
No, I'm asking you. You're the sworn witness. Don't you think he could have helped?
That's for Mr. Runcie to answer,
Mr. Chairman?
Mr. Chairman.
Yeah.
Mr. Runcie's been able to go out and talk to the press. Can't talk to a congressional committee with oversight responsibilities for the very fact he's allowed all kinds of billions of dollars improper payments to go out, but he can talk to the press. He can't come talk to us. That's why we need to subpoena the guy.
Well, we have votes, and so I'm going to give you about 30 minutes to think of a better answer, Mr. Hurt, okay? And so because I'm going to come back to that. We were going to adjourn, but at this point, we're going to just recess subject to the call of the chair. And for planning purposes, so you can get some additional tea, Ms. Ty, we're looking at about 30 minutes. So the committee stands in recess.